Welcome. Good morning, good afternoon, depending on where you are. My name is Paul Irving, and I chair the Center for the Future of Aging at the Milken Institute. I want to welcome all of you to our conversation this morning, Retirement Security in the Wake of COVID-19. This is part of our series that we've developed at the Milken Institute focused on the impacts of COVID-19. Each week, we have a group of leaders with us and for a conversation about a variety of topics. Topics in the past have included things like the status of vaccine development, and future calls will focus on issues like the effect of the U.S. stimulus package and the role of philanthropy in relief and recovery efforts. This call is being recorded and will be made available online tomorrow. We will have a Q&A session during the course of this, and questions can be submitted up to the end. But about at the 45-minute mark or so, we will begin to entertain questions from all of you. We're very fortunate today to have a fabulous group of speakers with us. Let me introduce them all. Pennington is the managing partner of Edward Jones, a Fortune 500 financial services firm with more than 49,000 associates and 7 million clients across North America. Marcie is the CEO of CalPERS, the nation's largest public pension fund, with a budget of 1.9 million, 2,900 employees, 2 million members, and 3 lines of business in pensions, health benefits, and investments. Seitz is the chairman and chief executive officer of Russell Investments, a global investment firm with $300 billion in assets under management and $2.6 trillion under advisement for clients in 32 countries. Russell is the 4th largest advisor in the world. And of course, we have with us Mike Milken, my colleague and the founder and the chairman of the Milken Institute. Mike has been at the forefront of philanthropic initiatives in medical research, education, public health, and access to capital for more than 4 decades. Their full bios can be found on our Milken Institute website. In just a moment of framing, we are going to talk about money today, but we should never forget that this crisis is first and foremost about health. As of this morning, approximately 55,000 Americans have died. And for those of us who focus on the well-being of older adults, we should note that approximately 80% are 65 and over, according to the CDC. In markets, in January, as we all know, the Dow Jones hit an all-time high of nearly 30,000 points, and since that time, it fell to under 20,000, and it's come back since then. But that gyration, that uncertainty, has certainly rattled retirees and pre-retirees across America. The retirement deficit has already been a significant challenge, and the Employee Benefit Research Institute projects nearly a $4 trillion deficit in that regard, potentially another 160 billion by the end of this year. Over half of adults age 50 plus have no more than $100,000 saved for retirement. Half of them have nothing. Half of that group have nothing. And the average 65-year-old couple will need, according to another major financial services firm, something like $285,000 between 65 and death, solely for medical and health costs. Many older adults need and choose to work longer. They want to work longer and really must, and yet they find challenges in that regard. Ageism and policies that tend to bias against them weigh heavily. We know that in the wake of the Great Recession, older adults not only had trouble finding work, but had more trouble than others being reemployed. And according to AARP, something like 90% of older adults believe that there is ageism in the workplace that impedes their ability to continue to work and to realize their financial aspirations. So in the context of all these challenges, let's get into it with our speakers and begin with our friend Penny. Penny, it's good to see you. I haven't seen you since last year's global conference, and I hope all's well for you and all at the firm.
Thank you.
Again, as I mentioned, you have 7 million customers, and you began as somebody dealing with them face to face. How are they feeling during this difficult time, and what advice are you providing as they deal with this gyrating market?
Well, Paul and Marcie and Michelle and Mike, it's great to be here with you. To everyone joining in, thank you for spending a little time with us today. So you just read some really sobering statistics, Paul, and really brought it home to us what we're all feeling right now, which is that there are so many things that are uncertain, and we're all looking for some certainty in our physical lives, in our emotional well-being, and what we're here to talk about today, our financial well-being. And we're finding out that those three things are inextricably connected. What I want to focus on a little bit is the things that we can control. And so what we're helping our 7 million clients do right now is controlling the things that they can control. It's what we've always been about, which is about first understanding what it is that's most important to them, family by family, individual by individual, and boy, aren't people talking right now very poignantly about what's most important to them. And to some degree, the categories are changing right now. Then we help our clients put together a tailored set of strategies to get them financially to those goals that they most desire. And all of our clients have more than one goal. Retirement is a big one. That's one that we're talking about now. But those goals are dynamically balanced against other things that are so important in our clients' lives. And then what we hope to do is to keep them on track toward those goals over the arc of their lifetimes through ups and downs, thick and thin. That's what we've always been about. That's what we're doing right now. And interestingly, for our health, we're finding out that some of the things that our mother told us years ago still work. Wash our hands. Be careful about being with people who are ill or might become ill. All those things that are being dialed up right now about how we can control our health. The same is true for what we're dynamically doing for our clients about how they can seek some certainty and sense of control over their financial plan right now. A big one of those is ensuring that their risk tolerance, their tolerance for risk in their portfolio of investments matches the way that their investments are allocated. And so I'm getting wonderful notes from our financial advisors whose clients are contacting them saying, you know, I'm seeing in the news that the stock market is down 30%, but I'm looking at my portfolio, it's down 10%. Why is that? Well, that happens because those investments are high quality and well allocated according to their risk tolerance. Our clients, many of whom are nearing retirement or are in retirement, know that there may be a period of time when they're not able to remove from their accounts quite what had been planned. But by taking the long view, and Paul, you said it, nobody knows how much time we have, but many of us have much more time than we think we do. And we've got to control what we can control through proper diversification, having a plan, and dynamically orienting that plan to what's going on in today's really bumpy environment.
So you're advising rebalancing it at this time, Penny, and I guess one of my questions is that maybe unlike the Great Recession, and we don't know what the ultimate market impacts of this will be. We feel, I think, in a sense, less in control maybe than any of us have felt in our lives. This is a kind of a once a century event. Has it changed the kinds of calls that you would otherwise get in a state of uncertainty? The kinds of calls that you might have gotten 10 years ago, or the kinds of calls that some of your older reps might have gotten in the early 70s when we had tough markets?
Yeah. Well, I'll go back to when I was a financial advisor, and a shock to our system, our entire way of being, was what happened at 9/11. And the kinds of calls that we got at that moment were much more financial, but they also had an element of everything that I thought I understood about the world has just changed. And I have to think about that as a human being. I've got to think about that. And that certainly has a follow-on effect to my financials. But first, I got to think about something that is core to the way I thought the world operated. What's happening now is very much the same. So the types of calls that we were getting from our clients had first to do with their physical well-being. That quickly went to their emotional well-being, and then at the beginning of this, I'm going to call it in the first 3 or 4 weeks of this, then it went to their financial well-being. That's flipped a little bit now that people feel like they don't feel a great sense of control over what's going on with COVID-19, but I think that they do feel that there's some information that they've got about washing their hands and social distancing and the local instructions that they're getting. And so what we're hearing from our clients right now, and we survey them on a weekly basis, what we're hearing from them right now is that the financial concerns have been dialed up. But what was really interesting about this one is this combination of the completeness of my well-being has been called into question. And so our financial advisors we're being asked by our clients to have that kind of really poignant conversation. But then our financial advisors are there to help clients take back control of what they can control. And it's the things that we've been talking to them about and, frankly, preparing them for during what's been a very sanguine market period over the last 10 years. And so our clients are saying, oh, this is what you told me was going to happen. This is what we were supposed to get ready for. And so taking back some of that control is what we've been all about with our clients.
Thank you, Penny. And by the way, if all of you remind me, I want to come back at some point relevant to all of you about the role of the financial services industry, because I've always believed that unlike health professionals, as important as they are, the financial services industry is really the only industry that interacts daily with people that seems to be in a position to provide this broader perspective, broader input and support and the like. Let's go to Marcie for a minute. So Marcie, you've been a champion of defined benefit plans, and of course, as we all know, in the United States, we've moved from a time when in industry many Americans, middle class Americans, were covered by defined benefit plans, and we've gone to a regime of defined contribution plans, which seem to provide inadequate support and kind of engender inadequate participation. Tell us a little bit about kind of the typical PERS beneficiary, number one. I think people oftentimes understand that. You've talked a little bit, Marcie, about what you describe as pension envy. I'd like you to explain that, and then a little bit about why you think maybe we need to have a broader conversation about kind of a new world.
I'm sorry, I didn't quite get that last piece.
You know, again, kind of explaining your thinking, which I know you've spent some time talking about why defined benefit plans are so important and should be reconsidered.
Right. Well, good morning, everyone, and thanks for having me on the panel this morning. So CalPERS represents about 2 million members here in the state of California. Many of those are still actively working. We have about 700,000 people who are receiving a benefit out of the fund. And the average benefit coming out of the fund being paid to the beneficiaries, and 80% of those benefits, or roughly 85% of those benefits, are being spent in the state of California. Roughly $3,100 a month is the average benefit that's being paid. The members of this system are the public sector workers who are working in cities and counties and for state departments who have really dedicated their careers to the public sector. These are not individuals who are going to make a lot of money throughout their career. These are not individuals who will be drawing a very large benefit throughout their retirement. Roughly 3%, I think that $100,000 annuity is something that gets a lot of criticism. About 3% of the population here at CalPERS receives a benefit that exceeds $100,000. But contributions, of course, were paid throughout their career. Higher contributions were paid for that benefit. Defined benefit plans for me, and it probably goes back to, my own childhood and how I was raised. I grew up at poverty level, and not to say that is a bad thing necessarily, but it did teach me a lot about the importance of having income throughout your lifetime, whether that is as you're younger, and I was a teen mom as well, and started working very quickly out of high school, started as a typist for a State Department, and really found that I was drawn to serving others and drawn to working in the public sector. And then over the course of about now 35 years to my role here at CalPERS, I really moved from being a typist, and the last half of my career has been spent on pensions. And a lot of that goes back again to my childhood, seeing my grandparents. My grandfather was a World War II veteran. He worked very hard throughout his lifetime, and he was a logger, if you know what that is. He felled timber, but he worked really hard, and they were able to accumulate a really nice savings account, and then had their Social Security. And obviously, not everyone has access to Social Security. Roughly a third of the members of CalPERS do not have access to Social Security. But it took one financial event that completely wiped out their personal savings, and then from that point on, for the next 15, 20 years, they attempted to live solely on Social Security. They did not have an employer-sponsored retirement plan. So that really has shaped the way that I look at lifetime income. It's shaped the way that I look at retirement, and the fact that I want people to have financial options. We want people to be consumers for life, not consumers only when they're actively working. We want them to be able to consume products throughout their lifetime. And so that has really shaped who I am and why I gravitated toward this career that's been really interesting.
So I want to come back to this question about the gap, and that's actually, it's a good introduction to Michelle, because Michelle has spoken about and written about this question, not just of the retirement gap in the United States, but the retirement gap globally. We appear to be heading in some ways, Michelle, toward a financial wall. Without some intervention, some significant intervention to change things. You want to talk a little bit about the work that you've done and that has come out of WEF and others on this question of retirement sufficiency.
Sure. Well, thank you too for having me. It's a pleasure to be with Penny and Marcie and Mike, you as well. The first thing I would say is that the first step to fixing a problem is admitting that you have one. Unfortunately, this crisis has brought the clarity of the need even clearer to everyone involved. But the stats that you just went through from the World Economic Forum is that we have a $70 trillion gap, and that was as of 2015, so it's even greater now. And it was expected to grow to 400 trillion by 2050. The problem with big numbers like that is you shut down. It just seems so big that you can't do anything about it. And it also doesn't have context. The context that was critically important to me and our team when we started to dive into this is that is a bigger number than the GDP of most countries. So in America, our retirement gap is 142% of GDP. So these are enormous numbers. And you said at the beginning just what Social Security will fund. That is the other element that we as an industry, and we're doing and engaging with our clients and always have, is really looking at what problem are you solving for. And as Penny said earlier, you solve for lots of financial needs throughout your lifetime, and Marcie used her real life example. The industry increasingly over the last 30 years fits and starts of a bull market, but anyone would argue that we've seen a culmination of a pretty astounding upward trend over the last 30 years that I've had the pleasure to be in the industry. And this has really woken up both the retirement gap as well as a crisis that's so broad in its impact on people's lives that it really does bring you back to center of what is the industry's purpose. And our purpose is to appropriately invest the savings of people, and to make sure that they are financially secure throughout their lifetimes, and especially when you're going to possibly live to be 100, as long as there are no further pandemic effects upon us. But that longevity to life means that it's not just the retiree generation, it's all generations that need to plan for various periods of their life where they may not have a steady income. Maybe they're reskilling, maybe they're going through different periods, they're funding for different types of needs. And so this focus on financial security is acutely high. For the generation that's approaching retirement, so 55 to 65, we tried again to make this $400 trillion more real and applicable to people. So if you just take pre-COVID-19 impacts, so if you just take the cohort of 10 years, 55 to 65 in the US, heads of household, there are 42 million heads of household that are in that 55 to 65 period. 75% of them pre-COVID-19, 75% of them had almost no chance of being able to fund their retirement needs. 10% were close. I would venture to say they're no longer close. And only 15% were safely within the realm that they could fund their current lifestyles at an 80% of. So it's a huge number. 42 million heads of household impacts more than 42 million people. And so the point of the industry, the point of the conversation is to come back to the hierarchy of needs. What do you need this money for? And it's not to beat an index. It's to make sure that you're crystal clear on what this money needs to be funding. And since we've served sophisticated institutional clients like CalPERS and Marcie's firm over time, as well as individual advisors and financial institutions, what we're trying to do is get that focus back on the funded ratio. How much in assets do you have, including your income, including Social Security, including any other assets that may come to you? And how much do you have in future liabilities? And think about a funded ratio that applies to individuals, a personal funded ratio, as much as we think about funded ratios for big institutions. And so just trying to make it as real to people as we possibly can. But Paul, as you said, just acknowledging that there is a problem, which has now unfortunately been amplified in a fairly dramatic way, means that we can at least start moving toward a solution. Maybe not, frankly, for this current generation. We might have to solve it in lots of different ways, which will include public, private, and individual partnership. But for the future generations, we have plenty of time to address this in a much more holistic and positive way so that we can stop the problem from magnifying.
Thank you, Michelle. So I want to come to Mike, but I want to warn the three of you that after Mike's remarks, I'd like to come back. So I think we framed the problem. It's a huge problem that requires not just system change, reimagination, and a new story, but obviously a lot of change in the financial services industry. So recognizing the inadequacy in the United States of Social Security, the limited scope of defined benefit plans, the challenges with DC plans, the fact that target date funds, in a sense, are blunt instruments, not necessarily customized to the peculiar needs of individuals. What can each of you do? What should each of you be doing to more specifically address the needs and aspirations and challenges of your customers and clients, and can and should the industry be doing in the wake of this? Before I do that, though, I do want to go to Mike. And specifically because, Mike, one of the things that I've always found most interesting about you is that you're a student of history as much as anyone I know, and you think of these things not just in a year or two kind of time frame, but over 50 years and 100 years. I know professionally, obviously, you lived through the 73 to 75 period. You dealt with challenges in the 2008 recession, et cetera. But you think about this kind of question of retirement and financial security, sufficiency generally over a long term. What's your perspective on where we are and maybe how not only leaders of firms like the three women with us, but individuals should be thinking about this challenge of enhancing financial security?
Well, it's an honor to be with Marcie and Michelle and Penny here. And I think in our limited time, I'd like to talk about broad issues that we need to address. First, this crisis does not have any relationship to previous financial crises. This is a crisis brought on by a virus and a health problem spreading throughout the world, not by the fact whether our financial institutions were over-leveraged as they were in 08, 09 and structure. So this is the first thing to understand and accept. Second, we need to remind ourselves, as I've reminded you 1,000 times, Paul, over the years, that 50% of all the economic growth in the last 200 years in the world can be traced to public health and medical research. And this has led with the greatest achievement of our societies over thousands of years, and that is in 4 million years of evolution, we extended average lifespan by 11 years. In the last 120 years, we've extended average lifespan by 42 years. And not only have we extended lifespan, but we've improved the quality of life. And so the Irrational Optimist, published in 2011, pointed out how a person in lower middle class or lower income was living better than the King of England. And all the benefits we recognize that the King of England had not had, Henry VIII. So what has occurred here? Number one, the demographic shift. Are we allocating assets to senior citizens, or are we allocating them to young people? The U.S. has 40 million plus people over 65. The world is getting older. China's 1 or 2 years younger than the United States today on median, but will be older, substantially older in 10 years. And so how are we going to allocate these resources? And those are some of the underlying issues that have been raised by each of our speakers today. And this will become a political issue from that standpoint. When we introduced Social Security, average life expectancy was less than when Social Security started. Mm-hmm. Today, average life expectancy in some countries in the world is in the mid-80s. So if you don't really get working till you're 25 and then you retire at 62 and you're going to live to 90, what's going to happen? The UN has pointed out they're projecting a 4 billion increase in this century in population on Earth, from what was 7 billion to 11. Almost all that increase lies in sub-Saharan Africa. Most of the countries in the world will have decreasing population, including the U.S., if it wasn't for immigration. The U.S. had the lowest birth rate ever recorded in the history of the United States last year.
Yep.
We had less children born last year in the United States than 30 or 40 years ago. Mm-hmm. And even though the United Nations is projecting a 4 billion increase in the world's population, they're projecting no increase in children. So all of this increase is occurring at older ages today. And so as we've discussed the challenges of a pension fund system, it's going to be far worse because we're going to have less people working for more people retired. Third area I want to touch on is the one that Marcie brought up, and that issue is defined benefits versus defined contributions. Today, no for-profit company can probably survive in a defined benefit situation because they've become a financial institution. What are future healthcare costs going to be? What are future pension costs going to be required? So they've moved to defined contributions where the company will contribute and the worker. And in order to get a value for the company, when General Motors went bankrupt, they were not working for their employees. They were not working for their customers. They were not working for their stockholders. They were not working for their creditors. They were working for their retired employees. And when they divided up the pie and gave out the stock, it was given to their medical plans, majority, and their pension funds. However, if I'm a worker, a public service worker, and I've made the decision to be a fireman and a policeman or whatever it is, or a first responder, whatever that issue might be, it's different for a state and a federal government. And so that is the trade-off. If I'm a teacher, etc., I might get lower current pay, but I have benefits, healthcare benefits, pension benefits, etc. And so I think this discussion is a very important one for our public employees, as Marcie has pointed out. What is the path you're taking in your life, and what decisions are you going to make? Next, we need to realize that interest rates are unbelievably low, and all of these promises of future payments or your future growth are relative to rates of return. In Japan, $17 trillion was deposited at zero. To save $1 million in 40 years of work, you need to save $25,000 a year, assuming your rate of return is zero. If you thought you're going to get 12% on your money, you only have to save $10,000 in the beginning. So the discussion of saving rates is really relevant to these rates of return. And now it's a question of asset allocation. That all three of our participants, what are the asset allocation of the country's largest pension fund? How is we going to allocate assets, whether it's at Russell or whatever it might be from this standpoint at Edward Jones, and dealing with individuals? How important is this decision? And we've seen it today more than any time in history. If you had invested in bioscience companies, Johnson & Johnson, Bristol Myers, Merck, Eli Lilly in the United States, these stocks are at all-time highs. You're not asking any questions about what happened to your portfolio. Your portfolio is done unbelievably well. If you had invested in health insurers, United Healthcare, Humana, these are near all-time highs. If you had invested in food retailers, Walmart, people delivering Amazon, Kroger, these stocks are strong. If you'd invested in the tech industry, industries of the future, these stocks are near all-time highs. However, those companies, through no fault of their own, if you were in a restaurant business, if you're an airline, if you're running a hotel, this virus has shut your business down. Not whether you're over-leveraged or not leveraged. Any leverage is at risk when your revenue goes to zero. You've lost 100% of your revenue. And I think the points made by our speakers are so important. This crisis has taken lives, but the lives that it has taken are small to the damage to the families, etc. The millions of small entrepreneurs who were independent and weren't worrying about retirement and had a restaurant or a business that they have, now their future is in question. Will they be able to hold on to their business? Will they be able to pay for their kids' education? Can they make their mortgage payments? Can they make the car payments? And these were the owners. The devastation of what's occurred here is beyond discussion we have today, and what effect it's had on families. If you think of Maslow's hierarchy of needs, we have shoved a large percentage of the population down to the lowest level. Am I safe? Can I provide food for my family? Okay, and so what I thought, not my retirement savings, but what my business was, this has been shaken, and that is why we have to get the economy open as much as possible. Allocation of assets, as you know, Paul, Schiller won a Nobel Prize showing you that rates of return on residential real estate over a 120-year period of time, adjusted for inflation, were zero. And when we consider the largest investment by most Americans is in their home, relative to what's occurred in the stock market. The stock market, NASDAQ, was up 30 to 40% last year, and it's only down 2% this year. So over a 2-year period, you've made 30% on your money. And yes, the S&P is off 9 to 10%, but it was up 20 or 30. So in a 2-year period of time, you've had a rate of return. But those are liquid assets. And if you're concerned about do you have enough liquidity, you can sell Apple stock in a minute at little to no cost. If you're worried about your house, are there buyers today? And what about your mortgage payment? And do I have to pay someone 5 to 6%? And do I have to put a new lawn in and paint my garage in order to be able to do that? So these are exceedingly important issues, and firms that are represented here and the 3 individuals that lead their organizations, their advisors, their advice is essential to the continuation of life as we know it for millions of Americans, and 2 million people living in the state of California are dependent on Marcie and her firm for their retirement and benefits and health benefits in the future. So
Mike,
I just want to stress that is why, lastly, Paul, every day is 2 weeks. There are people hanging on and say, can I hang on for another 2 weeks until this economy opens? Can I make it for a month? And that is why time is of the essence and why we need to open up our economy. You spoke about 50 to 60,000 Americans have lost their lives, but far more have been diagnosed, and it affected many of them also. And that 80% of those are senior citizens. So if we strip that away, 15,000 Americans have lost their lives who are under 65. Should we have shut down our entire economy, or should we have just sequestered those over 65 and those with other conditions, as we see those with high blood pressure and diabetes at risk? That is a question Sweden asked a very small population, 10 to 11 million people, and other countries are asking today. Is it safe to go back out? And I would say to you, as you know, Paul, our efforts, our substantial efforts here with 70 new vaccines and all these antivirals and dramatic change in testing gives us an enormous opportunity here to think about how do we reopen our economy. I would say, lastly, I would compare this to a cancer patient. 1 in 2 men get cancer, 1 in 3 women. When you're first diagnosed with cancer, what is the first thing you think? Am I going to see my children grow up? Am I going to see them get married? Am I going to see grandchildren? As your treatments put your cancer in remission, you think, I'm living with cancer. At the end, you stop thinking you have cancer. To me, in our society today, we want to figure out how to live with the coronavirus. We're not going to be thinking about dying as we improve our treatments. And how to live means how do we open our economy and what is normal. And what we do know is normal for senior citizens particularly is more tele-everything. Tele-food deliveries, teleconferences like we're having today, tele-travel that we're going to go on, tele-education, and so on. Individual healthcare companies today have more telemedicine visits in one day than they did in all of 2019. The world will change, and I'm sure our advisors will advise them how to alter their portfolios.
Thank you, Mike. So for the 3 of you, Mike has posed a series of challenges and questions, and I really want to go back to this notion of kind of leadership and the role of the financial services industry. So what we know is that people have to invest. What we know is that people are stressed and at risk, and Mike talked about the impact on small business and the PPP program notwithstanding. We know that the allocation of resources has not gone as well as maybe we all would have hoped. Each one of you are interacting in your own way with very large audiences. How do you, and obviously you're doing it both directly and indirectly through your subordinates, through your representatives, et cetera. How do you see the role of the financial services industry in stabilizing what feels like a very unstable situation right now? And what more can be done, obviously, to enhance health and wealth and security, number one, but number two, what can this industry do to contribute in ways maybe that it hasn't contributed in the past? Anyone, Penny, I think it looks like you want to take that on. Why don't you go?
Sure, I'd be happy to. What we're all talking about is longevity and not living to be rich, but living really rich lives. And that means living lives of our own choosing. And several folks on the panel have talked about essentially the power of the path that we decide for our lives, the decisions that we make. So what we are seeking to do as a large financial services institution is to really intersect with that desire for tens of millions of people. So I'll give you three things that we're very focused on. First, time is really important. So getting to younger investors, helping them recognize that they have time on their side. Michelle, you said it just a few minutes ago, the next generation of investors, what we're finding right now is their ears are open big time to longer term goals for themselves and their families and how they go about achieving them, because they're seeing their retired parents go through a pretty wrenching change right now. We're working very hard to get to the next generation of investors. Second thing that we're doing is working very hard to help people understand that they are better off with financial advice. Studies show that investors have on average 25% more assets if they're getting professional financial advice. It's not complicated what needs to be done, but it does require someone who can be objective, who can take the emotion out of investing, out of the complexity and the dynamics of trying to balance tough trade-offs associated with your goals. So getting financial advice puts people in a better position. We are seeking to access more and more clients across more and more generations, and frankly, more and more across the wealth spectrum, as we always have, to help them understand the power of that advice. And then thirdly, we believe very strongly that this is something that machines cannot do by themselves. Technology is really important. FinTech is here to stay, and it is giving access to all kinds of solutions and products and ideas and information. We believe very strongly it is the relationship of one human being to another human being that it takes to put all of this in context for an investor and their family. So that's what we're focused on, Paul.
Yeah. Well, if we've learned anything from this experience, it's the importance of human connection. So thanks, Penny. Marcie, do you want to take this on?
Yes, so I was really taken by a comment that Michelle had made earlier about this personal funded status. So we pay a lot of attention to that as an institutional investor, but I think extending that out into the consumer space, that you know, at given points in your life, you understand what your assets and your liabilities and your balance sheet looks like. But this is during a time where trust levels are low. Risk tolerance is low. Even the risk tolerance of my own board and my own team is pretty low, yet we have a 7% return appetite. And so I think, you know, we have to have, using FinTech, using other trusted advisors. I think advice is really important. Most individuals don't know how to invest. They need to rely on someone else to help lead them through those decisions. But I think an aggregator of this information that really presents that asset liability mix that any individual has, I think that allows them to start making decisions based on data, not decisions that they're getting, you know, advice from their coworker, which is where most people get their investment advice today, is they talk to their coworker, you know, which plan should I be invested in, you know, which stock should I buy? That's usually within like the water cooler conversation or across the workstation conversation. So we need to find a place where, you know, the brand of these organizations is extremely important. It leads directly into whether there's a trust level between that consumer and that entity. And then all of that is based on data, aggregated in a way that people can use it as information to make really important decisions sooner in their life. Right now, what we find is that people wait until they're about age 50 before they even start thinking about retirement and lifetime income. It's far too late. You need to start thinking about that at the time you enter the workforce. And then there are significant life events that happen over time that you should readjust or rebalance your own portfolio, rebalance your own expectations so that, again, you think about longevity risk, you think about market risk, and you need to bring those risks down as you continue to age. But I do think there's a role for fintech. I think there's a role for these financial advisors. Defined benefit plans should pay an adequate but affordable benefit, which also means that people need to rely on personal savings. But how do you accumulate that personal savings? You should be investing, and you should be investing when you're young.
Yeah, Paul, if I can jump in, these are great conversations. I would pick up on a few different things. The first is Marcie said data-driven about 3 times, and I couldn't agree more. I mean, we need as an industry to make it easy for people to make good decisions for themselves and hard for people to make bad decisions. So we need to use technology, interfaces, and make the ecosystem of investing simpler, so you can have fact-based, data-driven conversations that are personalized to the individual level. And again, Penny is absolutely right too. We are big supporters of financial advice, big supporters of private entities, i.e. corporations and public pension schemes, to be able to provide for their plan participants. But there are many, gig workers included, that don't have that luxury. And having the industry work in tandem with other entities, like superannuation funds eventually did in Australia, so that you can have both purchasing power and professional management, but default not to averages. Paul, you said earlier that target date funds were a blunt tool. That's because we default to asset allocations based on everyone being the same age, has exactly the same needs, and the exact same asset allocation. And it's better than nothing. It's better than no data point. It's better than asking your coworker, but it's not as good as using technology, consumer interfaces, and the plumbing of the industry to drive more personalized outcomes, even if you don't have enough money to hire a financial advisor and get lots of customized attention. And so we're doing that in many different ways.
Let me interrupt and ask you a question on that. So we've managed to decode the human genome, but we haven't managed to, it seems, to decode individual financial genomes. You've got this very interesting, just a minute on it, kind of experiment going on. You mentioned superannuation funds in your Australian business. Would you just talk about that for just a minute?
Sure. Well, it's more than an experiment. It's up, it's live, and it will be the future. And so the point is, and a quick little segue to the fallacy of averages, but back in World War II, the Air Force was struggling with plane crashes, and they couldn't figure out why. They ultimately determined that they had built the seats for the average size pilot, right? Lots of dimensions. They figured out the average size pilot. I think we all know there's no such thing as average, right? There was no pilot fell within the 30% range of median, right, of average. And so what we really need to do, which can be done, and I'm sure we do it in lots of different ways, but what we do in Australia is that we take 8 different data points and feed that into, a person's income, their net worth, how long they plan to work, what their current savings rate is, that all kinds of things about the individual that's very easy for them. They fill it out. I think Penny said many times dynamically, right? People's lives change and they don't think to pick up the phone or fill out a new form. We're making it very hard for people to do good things for themselves. So if we could make it much easier, if we could grab data from the right sources, we see they can flip a switch and tell us that we can work with their financial institution to see that they are spending money in a different way, or now they're a resident of a different state and they forgot to tell somebody that they moved, right? There are lots of things we can do with technology to get this more laser focused and as default easy as possible, so that, as Mike said earlier, we can manage the risk allocation, the asset allocation within client portfolios, but not just for an efficient frontier, for something that's very applicable to what their needs are. So whether that's values around ESG, or it's the hierarchy of needs that I just need money to be secure. But I think that most generations aren't thinking any longer about the luxury of retirement and vacation homes and things like that. I mean, this is very real money for very real needs. And I think it will do a lot to stop the politicization of this wealth inequity if we can get at this earlier and really use the industry in a very leveraged way and at scale to deliver customized solutions around these needs.
Good.
Paul, this is Mike. You made a very interesting point. I just want to pick up on it. Yes, we are dealing with this virus by using technology, DNA. And on January 11th, the DNA of the virus was given to the world. And 63 days later, because of it in technology, the first vaccine based on RNA technology went into a human being here in the United States on March 16th. The DNA, building these systems to let a person know unemotionally what they should be investing in, etc. Letting someone know if they were working for an oil company in Houston, maybe they shouldn't be holding oil or energy stocks in their portfolio since their wages were dependent on that.
Exactly.
And cause diversification. For most of America, where their largest investment is in residential housing, maybe they should have a lower percentage of their portfolio in assets related to residential housing. And so these things are created. The highest paid people today in America are often mathematicians who are building the analytical models and the AI to have, and maybe the greatest performing investor of all time, Renaissance Capital, is using mathematical models to try to figure out how to invest. But I think your point was a really important one. We need the DNA of an individual, what their risk tolerance is,
Yep.
and maybe they need more conservative. In Japan,
Sure.
What did we learn? We learned that the citizens in Japan elected to get a zero rate of return. They had no tolerance anymore to lose money, etc. And the last point I would make, Paul, that was brought up initially here by Penny, I want to emphasize. There was a poll last year, and you know, Paul, for the last 6 years, we've been building the Center for Advancing the American Dream in Washington, across from the Treasury and the White House. In this survey last year, they asked Americans, what do you think the American dream is to you? The lowest response was personal wealth at 16%. Number one response was the freedom to raise their family. Number two, the freedom to raise children. And number three is enough in retirement savings to live a comfortable life, not a rich life, but to live their life as they want. And I think that number is almost 5 times personal wealth. So they're thinking about retirement that gives them freedom to live their life. And I think that's one of the most important elements of this discussion today.
Yeah, well, and thanks, Mike. We all know the relationship between wealth and happiness dissipates fairly quickly at high numbers. So life is about more than money. We all know that. I want to just get to a couple of questions very quickly. We have limited time. So here's what I'm going to ask. 10-second responses, if I can do that. The first question we have is actually from our friend Rick Edelman, who started and runs the nation's largest independent RIA. Rick asks, the Social Security Administration issued its annual trustee report last week, produced pre-COVID, saying that the trust fund will be completed in 2035, a year later than prior projections, thanks to what was then a growing economy. The BPC just released a report adjusted for COVID that says it will be depleted in 2029. Comments on the Social Security Fund? 10 seconds. Who wants to go? Marcie, why don't you?
Depleting Social Security and not having that as an income would be catastrophic. And so obviously attention needs to be paid there. This is a solvable problem. If the right attention goes to it, it's been a solvable problem for decades.
Others? Penny?
10 seconds, Paul.
Mike?
It's a function of rate of return. When governments yield nothing, you don't get a rate of return on U.S. governments. Japan allowed their effective pension fund system to diversify, and by letting them diversify, get a rate of return. But if U.S. government securities are being driven close to zero, all that means is you'll get little to no appreciation. At current rates for the 30-year bond, it would take 40 to 50 years to double your money. Okay, and so one of the questions is, what should they be allowed to invest in? A very politically charged issue. And two, if life expectancy in America has moved from 50 at the start of the 20th century today to mid to high 70s, what should retirement age be?
Another question there, very quickly. It's this one we could have a long tea session. Actually, Mike, from our friend Bruce Raven, he says the Great Depression changed the psyche of a generation, and this will too. What changes in investor behavior might come out of this, and what is the impact on economic growth? Again, 10-second observation. Who wants to take it? Penny, you look like you're chomping at the bit.
Well, you're exactly right. This will be defining for those in retirement and those who are watching their parents work through this. I expect that more people are going to be looking for more advice. I think we're going to be more attuned to our health, and we're going to be more attuned to our financial well-being, and more people are going to be looking for trusted advice.
I'd say, Paul, 10 seconds.
Go ahead, Mike.
The Depression in World War II made families dependent on the government for survival, for access to jobs, money to sustain themselves. The baby boomers, of which I'm the oldest, the 1946 group, were told by our parents, you can be anything you want to be, and one person can change the world. So I'd say one of the things that's going to occur is the relationship between government and individuals to protect our health and make us safe is going to play a much larger role.
Just quickly, I believe in the intelligence of investors, and I believe in the resilience of humans. And so I actually believe that this can be a silver lining. I believe that lots of people can see the critical need to not assume that their incomes will go uninterrupted forever. I have 5 children. They're all doing their online studies at home. The oldest is 21, but we're having very interesting conversations about things they no longer take for granted. So I believe that we could have a moment where people take quite seriously this need for individual, private, and public partnership to come together and make sure that we're providing for lifetimes of rich lives.
Thank you. Marcie?
Yeah, I think just real quickly at the portfolio level, I think post-COVID-19 is just going to quicken the pace of some of the macroeconomic drivers that we were beginning to see emerge. I think this is going to quicken those by a number of years.
So unbelievably, we've come to the end of our hour, which I should have known that we had way more than an hour of content with the 4 of you on screen. But what we have to hope is, and I know that Mike Milken shares my hope in this regard, that we'll be able to redo this session in purpose at an upcoming global conference where we can actually convene and if we can't shake hands, at least bump elbows and wave at each other soon enough. So let me thank, on behalf of the Milken Institute, Penny Pennington and Marcie Frost and Michelle Seitz and our chairman, Mike Milken, for a great session. And for those whose questions didn't get answered, my apologies, but hopefully we'll be able to interact going forward on all those good thoughts. So thanks so much, all of you. Stay safe, be well, and take care.
Thank you, everybody.
Thank you, Paul. Thank you, Mike. Bye-bye.
Be well.